And now for something completely different.
Forget everything you've been told by others before.
There is a niche. Niche? 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 Niche. It's a niche.
I don't know.
It's a niche. The niche. It's a special area. There we go.
Get ready for the real deal.
Most important question, Lance.
Yes.
Pineapples on pizza or no?
The full story.
Me personally, if I'm going to eat a pizza, it's going to be a pizza.
I'm not going to order pineapples on a pizza, but I'm also not going to chastise somebody for doing it because I really don't care. Do what you want to do.
The whole enchilada.
So when you eat chili, beans or no beans?
No beans.
It's money news and information you can use to grow financially healthy, wealthy, and wise.
Your Excel Word example. It's a great example, right? Because there's Google Sheets, which does
Lotus.
Word.
Lotus
Does,
1,
well,
2, 3.
loaded. Okay, boomer.
Now, welcome in The Real Deal, the real investment show with Lance Roberts. Presented by RIA Advisors.
Hey, good morning. Welcome to the show. Of course, it's Monday. It's also the beginning of a new month. We're beginning the month of March, which typically tends to be, historically anyway, at least a better performing month. Maybe not starting out that way today, of course. Don't know if you happened to hear over the weekend, there was kind of a little dust up over in Iran. So again, that's going to impact markets out of the gate this morning. There's a lot of stuff going around. I'm going to open up the conversation today. So if you've got questions in chat, I'll try to answer your questions as well. If you have issues you want to talk about in reference to this, but we're going to go through a little bit about what's happening, why it's happening, what the impact to markets historically are. But there's right now a lot of overreaction in the markets. I've seen people over the weekend saying, oh, the markets are going to open up 20% down on Monday morning. We're down about 1%, right? Oil prices are going to 100 by Monday. We're up about $6 this morning. I mean, we've gone through this before numerous times. This is not the first time that we've dropped bombs on Iran. We just did it recently when we destroyed their nuclear facilities over there. So, we go through this quite often in the markets. And the markets do initially react. Kind of normal situations like this, or that oil prices do spike up a bit until we kind of get a handle on what's happening. Stock market prices do pull back a bit. Uncertainty, right? Not surprising. I want to take a little bit of money off the table. The dollar typically strengthens during these events because money looks for a safe haven. So again, these are the things that occur during these type of events, but they're not these catastrophic end of the world things, right? And I saw a lot of conversations over the weekend. It was like, this is an illegal war on Iran. We're not at war with Iran. We have a military operation with Iran, which the president has full authority to do. He is commander-in-chief of the military. He has full legal authority to launch military operations in other arenas. We're not at war. If we're going to go to war, then yes, if we're at war with Iran, then yes, it needs to be approved by Congress. But these are the exaggerations that occur on the media, and this is to get clicks and views and those type of things. So just be careful, kind of sorting through the chaff, so to speak, and just really focus on what has happened. And I'm going to show you a couple of charts this morning, but again, when you look at your portfolio, just pay attention to what's driving the portfolio going forward. And these events are certainly important. They happen, right? We had Lehman Brothers back in the financial crisis, right? We've had the dot-com crisis. We had the bombing of USS Cole. Those certainly cause short-term impacts, right, to the markets. But at the end of the day, when that impact passes, markets go back to focusing on what matters, which is earnings. So focus on the earnings. Here's another question for you, just to think about, is that how does us taking military action in Iran affect the earnings of Costco, right? Or Walmart, or Microsoft, right? So just think about the connection between what supports the stock market price versus what ultimately happens. And look, there's certainly uncertainty, right? And that's causing the volatility, the VIX index to spike up a little bit this morning. That's causing stocks to sell off a little bit. Uncertainty, certainly a reason of what happens. That's certainly a logical response to what's happening overseas right now. But what does that mean long term for these companies? Are there opportunities in this, right? So energy stocks are going to be up this morning because of the rise in oil prices. But how long will that rise in oil prices last? because that's going to be important. If OPEC Plus over the weekend already announced that they're going to increase production, Iran said that they're going to block the Strait of Hormuz, but the problem is they don't have a Navy anymore or a naval center. So not sure how they're going to block the Strait of Hormuz. But those are the things that we need to consider in this and how this affects the earnings of these companies. You know who does well also during these type of operations? Defense contractors. Raytheon, Palantir, these type of companies are involved in the Defense Department actions. They do well. These generate money flows for those. So again, the important thing is whatever position you're on, right? Whether you agree with the actions or not, when it comes to the markets, just sort through the headlines and get down to what actually matters, which is ultimately going to be earnings. Who benefits? Who loses? And there is going to be winners and losers that come out of this. And so make sure you're positioned, properly within the markets. And again, when this is over, those positions will reverse. And the things that got beat up are likely to start attracting inflows, because as things reset back to normal, companies that present an opportunity, money's going to find that. So again, just think logically through kind of what's going on. Try not to let emotion and fear and kind of present a panic move in your portfolio. I wouldn't suggest doing anything out of the gate this morning, because we've seen these type of actions before where the market opens down 1.5%, and then ends up positive by the end of the day. So if you kind of panic react this morning and make a big move in your portfolio, you could wind up on the wrong side of the trade by this afternoon. I'm not saying that's going to happen, but we've seen that happen before. And again, we'll kind of talk about some of this here in a few minutes. But here, let's talk about what you need to know before the bell this morning. Let's just kind of get in the technicals of where we are with the markets and what's likely to happen. So on Friday, in particular, we kind of discussed the bull-bear case for the markets. We talked about last week this kind of potential here that we may be building a little bit of a topping process for the markets. We're sitting right on support at the 100-day moving average, and we've been testing that 100-day moving average now for about 3 weeks and have not violated it yet to any great degree. We did kind of punch through it, but then recovered above it. We're going to open the day, we closed Friday at about 68.60-ish on Friday. So again, this morning markets are looking to open down about 1%. So we're going to come back down and we're going to potentially take out this 100-day moving average, at least at the open today. So the question will be, do we remain below and close with the 100-day moving average, which has been support for the markets? Do we remain below that level today, or do we recover and get back above it before the end of the day? We won't know that obviously until the end of the day, so we'll talk about that tomorrow. But momentum continues to be very weak here. The relative strength index is declining. That's a little bit concerning here. And again, this is kind of this thesis behind, kind of the more bearish narrative side of this, is that we are potentially making a little bit of a topping process. We could see a push lower in prices. Depending on what happens overseas, that could certainly help this push lower in prices, at least near term, as people kind of pull money off the table just in a defensive posture. So again, we need to be aware of that risk and see how today kind of resolves itself. But again, this morning, the markets are going to be down, about 1% or so at the open. We'll see if that, again, is that the knee-jerk reaction at the open, then the markets begin to, do we see buyers come in? What we have seen along this 100-day moving average repeatedly is that buyers step in at this level. Do they step in today? That's going to be the question that we're going to look at. As I said, the dollar tends to strengthen here a bit. Dollar's going to be a good bit stronger today. The dollar's actually been recovering nicely over here just recently. We had this initial kind of knee-jerk reaction back in early January, but since then we've been seeing a nice recovery in the dollar. So money's been coming back into the U.S. dollar. That's been strengthening. This kind of action overseas certainly lends support to that money looking, if you've got assets held overseas, particularly in areas that might be affected by geopolitical risk, moving back into the dollar in terms of the safe haven play is not surprising. We've kind of seen that as of late. So this kind of tension was building with Iran. We kind of saw this move back into the U.S. dollar. We saw it move into treasuries. So that's been kind of supportive of late. And again, this is kind of the 10-year treasury yield. 10-year treasury yield has been dropping really sharply here. We got below 4% on Friday, closed at about 3.9. Yields are up just a little bit this morning. We'll see how they open up today and where they kind of trade. But if money's flowing into the dollar, that should keep yields at a fairly decent level. We shouldn't see a big jump in yield if we're seeing more of that transition kind of into a safe haven near term. But speaking of yields, though, yields are extremely overbought here. This move that we've had has been very sharp. This big sharp drop in yields has been very sharp. We're extremely overbought on yields. So I would not be surprised to see yields at some point, not because of what's happening in Iran, but just simply from a technical base, see this kind of move in yields move back up towards 4.1%. Now this would make sense also because if you take a look at what's happening with crude oil as an example, so here's crude oil, big spike this morning. That's on what's happening with concerns over Iran. That's going to feed into inflation. There's a decently high correlation between oil prices and inflation. So if inflation picks up because of the rise in oil prices, particularly if this is sustained here for a while, you're going to see that feed through to inflation. That should pick yields up to about 4.1%, which would work off some of that overbought condition that we have right now in yields and kind of the overbought condition in bonds. So again, if you're just trading bonds, this is a really good place to maybe take a little bit of profit off the table. Look for a better entry point on a reversal in yields, just particularly because, particularly as oil prices feed into the inflation number here over the next couple of months. But speaking of oil, oil is extremely overbought here and very extended from long-term means. So sustainability at this level is going to be a bit challenging. So if anything cools down overseas, we could very well see a drop back here in oil prices back into the 60s. That would also work in reverse on the inflation data. So again, with respect to inflation, sustainability of high prices in oil are going to be more consequential for inflation. If this is a temporary spike that drops right back down again, then the inflation impact won't be nearly as bad. Anyway, that's what you need to know before the bell this morning. We're going to come back, pick up, and talk a little bit about what's going on in Iran. Really good balanced piece in the Wall Street Journal. I'll read to you just a little bit from that. We can have a discussion about it. Also get into this kind of bull-bear case for this topping process for the markets. We'll go through all that this morning. So coming right back on the Real Investment Show. Don't go away.
Catch the best of The Real Investment Show anytime, anywhere from iTunes. Download podcasts of The Real Investment Show from iTunes.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the show. All right, so a couple of things here, and again, we'll try to get through a few different things here. I wanted to initially just show you a chart that I actually posted not this past weekend, but it was in the weekend before last, as this whole narrative for Iran was starting to build. And again, we hadn't made the attacks yet, but this narrative of what was going on in Iran was starting to build, and there was, a lot of people out claiming that, we're about to go into World War III, and a U.S. strike on Iran could unleash, a war, and so there was all this concern. And so I actually addressed this, and again, the weekend before last newsletter, and I wanted to show you two things, really two charts here. So Brent, can you bring this first chart up for me? This is what I was saying a second ago about oil prices and inflation. And oil prices are important because they do have a correlation with inflation. But just because oil prices go up doesn't mean that inflation overall comes up, right? So there is a correlation, but it's not a one-for-one correlation. So this spike in energy prices will impact inflation. We will likely see inflation pick up a little bit again
if oil prices are sustained. But, we've seen these spikes in oil prices before where, again, you'll kind of go back to 2012, 2013, 2014, 2015, oil prices were high, but inflation was cooling overall. So again, there is a correlation, but it's not exact. But it's worth noting that high oil prices will feed, because look, everything we do, eat, consume, travel, wear, use, has oil in it of some sort. There's some petroleum-based product either in the manufacturing of, the use of, the transportation of, oils impacts that. So that's all going to get fed into price at some point. So if oil prices are sustained higher, that's going to impact inflation. And that's what I was talking about with yields a moment ago. But here's the chart that I wanted to specifically address, because we've been through these periods previously. This is a chart of the S&P 500 going back to 1900. And what I've done is I've overlaid various military conflicts on this over time. And what's important to notice is that, yes, at the initial onset of a military action or conflict, etc., markets can have an impact. And there's certainly things that are negative about military conflicts. They're not good. We don't like these things. But it does cause near-term uncertainty. But there's also, you have to be careful because, again, just because there's a military encounter of some sort doesn't necessarily mean that's the driver of the sell-off in the markets. For example, the bombing of the USS Cole, or when we entered the war in Afghanistan, right? We were in the middle of the dot-com crisis at the time. So you can't look at this chart and go, well, look, there was a huge decline after we went to war in Afghanistan. There was this huge decline in the market because of the war. No, it was because we were in the middle of the dot-com crisis. So it's important to separate out kind of what market dynamics are versus what's happening in the markets. But the important lesson to learn here is that because you have these military conflicts, it does not lead to a massive sell-off in the markets. What causes very large sell-offs, and again, I saw some people out yesterday on X and other things just saying, my base case is market's going to open Monday morning at 666. It's just, that doesn't ever happen. That's never happened historically over this type of thing. And so it's try to set some of these narratives aside and focus, again, what really matters for markets, which is ultimately who wins and who loses from these conflicts. And because it's about earnings. At the end of the day, this is all going to come back down to earnings. If we take a look here, let's just do this as a good example. Let's just take a look at FinViz real quick here. And this is just kind of a simple website. If you've never used it, it's very easy to use. It's simplistic. But it's got some nice little tools to it. And one of those is a heat map. I'm waiting for them to update their site. But what we're going to see this morning is we're going to see energy stocks moving higher this morning because of what's happening in oil prices. You're going to see stocks like Palantir do well this morning because of their defense contracting abilities. You're going to see defense contractors do well. So you're going to see companies like RTX do well. And you're going to see companies that are doing well in other areas of the markets also that have a benefit from military actions. Now, whether or not that is sustainable, we'll see, right? But this is kind of the point, is not to overly. Okay, I got them to finally update here. So they finally updated this morning. So again, this is a heat map for the market for the S&P 500 this morning. Now, what I want you to notice is, so again, you can see that big green spot down at the bottom. That's energy stocks. You see the defense stocks, RTX, GE, Boeing. Those are all leaning towards green. Palantir up in the left corner, that's green. But the rest of the market is down a little bit, right? But there's not any stocks in here that are down, 15, 20%, 30%. The market in general is down about 1% going, for futures this morning, kind of going into this. And in fact, if we just kind of look at the futures markets, the Dow's down about 1.15%. We're looking at about 1.1% for the S&P. The Nasdaq's down about 1.3. So again, it's not mass devastation, right? Crude oil's up, Brent's up, those type of things. Those are up, kind of defensive areas. The VIX is up here on the right. That's rising. So everything that you would think would happen with this type of conflict is exactly kind of what's playing out, but it's not these massive devastating extremes that you should be panicking over this morning. And again, from the kind of the tweets and the texts and things that I saw over the weekend, I was like, oh my gosh, what does this mean for Monday morning? This is going to be terrible. It's going to be devastation. It's just, that's not how markets react. And again, I would not be surprised. It will not be surprising at all if this market opens down this morning and then starts rallying back by this afternoon as things kind of start to wean themselves back to normality. But, I did want to kind of just, like I said, there was a really, really good article. Let's just talk about what's happening in Iran here real quick, because this is going to be the if you get onto social media, depend on how your social media is leaning, you're going to get a lot of varied opinions on what's happening overseas. But the Wall Street Journal did a really good kind of balanced analysis of this. And if you look it up on the Wall Street Journal, the title of the article is called "Trump Enforces His Red Line on Iran," which was, and again, they wrote a really well-balanced piece about this. And it just starts, let me just read to you this kind of opening paragraph because it kind of sums things up a little bit. The U.S. Israeli attack on Iran that began Saturday morning is a necessary act of deterrence against a regime that is the world's foremost promoter of terrorism. It carries risk, as all wars do, but it's also the potential to reshape the Middle East for a better and lead to a safer world. Crucially, what they go on to address is that there is a, not a need, but this has been an issue that has been brewing for some time, and the state of the problems with Iran have reached a level that required some type of action. Again, this is a country that has killed thousands upon thousands of its citizens over time, and on the verge of acquiring a nuclear weapon, which again may not be in the best interest of the world as a whole. But again, I certainly encourage you to read this article in the Wall Street Journal, because again, it's a very balanced piece as to why this is being done and what this potentially means. So kind of with that background, this is where we come back to focus on, okay, what does this mean for companies in the U.S. and what does this mean for markets in general? There's a lot of, again, in the media, there's a lot of just two sides of the narrative. One is it's the beginning of the end of everything. The other side is this is great. People are cheering all over the world for this. It's fantastic. But again, as investors, we need to just remain kind of focused on what ultimately matters in the markets, and that's the risk that we take into this. So this and unfortunately, we're entering this in a period of the market where we don't have a lot of strength, right? The market's been weak as of late. We've been kind of flirting along this kind of support line in the markets. So a negative action like this is certainly going to put pressure on prices, and we're going to start potentially threatening those technical trends of the markets, which if we take out key levels of support, these algorithms and computerized trading and everything else that kind of occurs in the market, there's a lot of eyes that are currently looking at that 100-day moving average, because that's been where buyers have repeatedly stepped in over time. If we take that out, there is risk to lower prices. And this was really the context of this weekend's newsletter, where we spoke specifically about this market topping process. And what I did is, when I went through the newsletter, I laid out this in a bull bear case fashion, right? So I said the bear case for the market top is markets are topping. What type of correction are we talking about, and why do the bears think that we're topping in the markets? The bull case is the opposite side of that. So I just thought I'd go through with you for a minute here, just kind of touching on the technicals of this, kind of what's driving this kind of bull case support. This was a chart I posted. So this was a chart I posted on Saturday. So again, this doesn't have today's action in it yet. But what you'll notice is that the chart changes without my permission. What you'll notice is this, as I kind of drew out here, this parabola of this kind of action. We were making higher highs and we were building higher lows. That's now started to cease. We've now kind of been making, as of late, lower highs, and we're still holding the lows. The lows are holding in here, but we're making these lower highs, and we're sitting right on support there at the 100-day moving average. Again, we're seeing a lot of deterioration in the markets across the board. And we're also seeing at the same time, we've been having this rotation from previous leadership, financials, technology, and healthcare, into the previous laggards. So we've seen the defensive sectors doing much better. And historically, that is a late stage. We've written about this a couple of times. Those are kind of late stage cycles of when that occurs. When you start to see that rotation into these other areas of the market, that tends to be at the latter stages of a market advance, right? Now, so now we're going through the bear case right now. We'll get into the bull case in a second, so just bear with me. So the thesis that we're in this market topping process is really twofold. One, technically, we're starting to see some breakdowns. And then secondly, we're seeing this rotation in the markets to the areas of the markets, by the way, which have the weakest rates of earnings growth, but have been underperforming for a long time. So it's kind of this catch-up move. And at the same time, we've got a very high number of sectors that are all trading above moving averages. Now, that's good. Breadth is good in general, particularly when it's rising breadth. However, when everything is trading above its 50 and 200-day moving averages, that's typically later in the cycle. So you'll notice that in this chart that when you have these areas where you've got very high levels of everything trading above their moving averages, you typically have little short-term corrections. Again, we're not talking about massive 50% declines, but markets tend to peak. You typically have a bit of a correction, 5, 10, 15%, whatever it is. Markets bottom, you work off a lot of that very overbought breadth. You work that back, and that correction gives you an ability to trade the next advance. But again, so breadth is very strong, which, again, when everything is doing well, that's good, but that's also typically late. Markets are getting overbought. They're getting extended areas, things like that are getting kind of ahead of themselves. So again, from a bearish perspective, this is kind of one of those areas where you go, okay, I need to have a little bit of caution here. The other side of this is this deviation that we've had between the equal weighted index and the NASDAQ. Again, that deviation of performance, as we were talking about before, is when you see that rotation from leadership into laggards. That typically is a later stage cycle of an advance. That type of rotation typically doesn't happen at the beginning of a bull market cycle. It tends to happen at the end of a bull market cycle. Again, we're going through the bearish case, so just hold on for you bullish guys. We're about to get to the bulls. So these are the things that support this narrative, at least, of a kind of a market topping process. And one thing too is that we've had this market that's rising, but we have this deterioration in both breadth and momentum. That's also tends to be kind of a negative sign from a technical base. Again, so the bears have decent arguments that the markets can be topping here. And this is why we've recently reduced some exposure to equities. We've kind of started raising a little bit of cash in portfolios, kind of repositioning portfolios here a little bit, because there's certainly an argument to be made that this market has had a very strong advance from last April. It's very extended on multiple measures. A lot of sectors are trading at very, very big extremes from their long-term means. So you're going to have some type of corrective action at some point, and the question is, where's that going to show up the most? But it will be reflected in the market as a whole. But let's talk a little bit about the bullish case as well, because again, the bullish case is the other side of this. There's been a lot of periods historically where markets have done these consolidations. So instead of this being a market topping process, how about a market consolidation where it's just traveling sideways for a bit? So the bullish case is that this is just a market consolidation. It's not a top, and that the market's going to continue higher as things recover. Then there's some decent supports to that. First of all, earnings are doing very well, and earnings estimates are being ratcheted up right now. Economic growth is showing signs of picking up. If you take a look at the recent manufacturing indexes, the recent PMIs, the recent data on employment is actually showing some signs of recovery. We're starting to see a little bit of economic pickup in the United States. That's going to help support these earnings, which also are improving. And we're seeing the earnings beats, the revenue beats in the last earnings cycle were very strong. So there is good support for the market. From a fundamental basis, there's good support for the markets right now that this is just a base, that, we may have some wiggles here, but eventually we're going to kind of work through this process, work off some of this previous overbought condition, work off some of these extremes. What's happening right now from the bulls' perspective is that this consolidation is fine. We're just going sideways, but that's allowing those moving averages to now catch up to the market. So those big deviations that we had between the price of the market and, say, the 200-day moving average, which we had very big extreme deviations there. And remember that moving averages kind of act like gravity, so they're going to try to pull prices back to those moving averages at some point. Well, consolidations allow those moving averages to catch up. So these consolidations allow the market to heal itself up without having a big correction in price. And if earnings are improving and economic growth is improving and economic fundamentals are improving, that helps support this kind of bullish narrative. Furthermore, if you take a look at, again, as I was saying, we're seeing some improvement in some of the employment data. Recent ADP reports are showing signs of job growth. Not fantastic, right? They're not blowing out the doors by any stretch of the imagination. But jobless claims are remaining very low. We're not seeing a big uptick in jobless claims. There's a lot of concern about AI is going to displace a lot of labor. We are starting to see that in some areas, but overall, the economy is still doing okay, at least right now. Again, we're talking about right now. We're not talking about 5 years from now. We're talking about right now, right? Bull case versus bear case, consolidation versus correction. That's where we are. And a support for the bulls right now is this kind of improving employment situation, because that helps support the economy, helps support earnings. That certainly at least is a support for right now. Now, technically, this is a long-term chart of the market. So this is a weekly market going back to 2007. We're still within a very bullish trend. Now, one of the concerns, and this is a bearish concern, one of the bearish concerns is we're trading at the top end of that rising trend line from the 2009 lows. So we've been in this nice broad channel ever since the financial crisis. We're still in that channel. We have not done anything about that. But we're still above the 40-week moving average. We're still above the 52-week moving average. We're still above the 208-week moving average. That's 4 years. So all those rising trend support lines, and if you'll notice that red kind of moving average, that's the 4-year moving average. That runs along all the bottoms of the markets. That's been running trend support for this market outside of the decline in 2020 and kind of 2018. That support has just remained in place. In 2022, we came down, we touched the 4-year moving average. We approached that moving average last April. We cracked it for a moment during 2020. 2018, we touched on it. 2015, we touched on it. So that 4-year moving average has been a very, very strong trending line. Now, unfortunately, to correct back to that level, if we do at some point, so this is back to the bearish case, if we do get a correction that takes us back to that 4-year moving average, that's going to be a pretty substantial decline, right? So what that case would be is like you're looking at a 30, 40% decline to get back to that 4-year moving average, because we are very deviated from it. But from a bullish perspective, we're still in the bullish trend. The the 1-year moving average is not that far below where we are right now, so there's decent support on any type of pullback. But the overall trend of the market remains very bullish. So this is why the bulls are kind of very supportive here of the market's near term. So this is a consolidation. This is not a top. Also, you have a lot of fear getting built up in the markets. The CNN Fear Greed Index has dropped from greed and really extreme greed last year back into fear, and that's been working its way lower. So you're starting to get a lot of the bulls that were in the markets are now getting kind of back into the bear camp, which is a positive for the markets as well, right? So negative sentiment is bullish for the markets because the more people that are off sides, when the market begins to rally, they have to get back into the markets, right? So you have to convert the bears back into bulls. And if you take a look at the American Association of Individual Investors, they become substantially more bearish as of late. Take a look at the National Association of Investment Managers, those professionals. They've gotten more bearish as of late. They're bringing positioning off the markets. That provides fuel for the market to advance. And again, as we talked about earlier, that short positioning in the markets is very extreme. So you've got a lot of short positioning in the overall markets. And if you take a look at the kind of this lower left-hand quadrant, the market is temporarily very overbought. But again, that overbought correction process can occur fairly quickly. But markets overall are doing fine. They're healthy. Technology is extremely oversold. Financials are extremely oversold. We may see a rotation in between the areas, these defensive names, staples, utilities, industrials, materials, energy, those are extremely overbought. We could see a rotation, profit taking out of those, and a rotation back into growth. But again, this what's happening in Iran right now is going to delay that to some degree. But that's potentially where the setup is. So again, we could see this rotation in the markets that pushes money back into the largest cap-weighted sectors of the market, and this market continues just to stabilize here rather than declining. So that's the bull case. Now, however you want to position yourself, that's up to you and how you want to approach it, but there's certainly arguments to be made on both sides. So the way we're approaching this in our portfolios is that we're just being a little bit defensive. We're taking a little bit of money off the table, so we were running overweight equities for most of last year. We've reduced that back to we are now very slightly underweight equities in our portfolios. We may go a little bit more here, but mostly what we're looking at right now is just repositioning the portfolio from a little bit of offense back into defense and looking at areas that we had moved into last October. We were talking about the rotation from growth to value, and we added some value stocks like Altria and Verizon as an example. Those have done very well. Taking profits in those and then starting to move back in areas that have been really beaten up for that next rotation if it occurs. So again, just being a bit defensive, but not being bearish at this point. Because again, there's no indication right now that even if the market does top here, that the correction will be more than 3 to 5%. We'll find support. Markets are going to start looking at fundamentals. They're going to start looking at earnings growth and kind of move forward from there. Again, this issue with Iran certainly puts a short-term wrinkle in analysis because, again, you're going to get this variability in markets due to the unknown of how this is going to mature. But if this is over in a week or 2 or 3, we're going to return back to normal. If this thing drags out into a Russia-Ukraine war where it just goes on for a year or 2, which I don't think is the case, but that's going to have a very different impact on markets if that occurs. So again, we don't know how this is going to turn out. No one does. But what we do know is that historically, looking back at markets, these tend to be fairly short-lived events. And they do have a short-term impact on markets, sometimes bigger, sometimes smaller. But we do get past them, and over the course of the next 12 months, markets tend to perform better. Once we get through this kind of initial shock phase, markets tend to do well. So again, I don't have an answer for you. I don't know exactly what's gonna play out. So the only thing I can encourage you to do is just to be a little bit cautious about your positioning. Think about where your risk is. Things that are extremely over. Just spend a few minutes with some technical charts. Things that are extremely overbought, take some profits. Things that are extremely oversold that have great earnings growth and companies that you like longer term, maybe add to some of those. Take advantage of the pullback here to buy some things cheap. Think about just holding some extra cash right now. There's no reason to do anything. If you're really uncertain about how to position your portfolio, there's nothing wrong with just holding cash or even short-term T-bills, which are effectively cash with a yield. But that just gives you optionality. And so if you're uncertain about what you should do, just hold a little bit of extra cash right now. There's nothing wrong with holding some cash in your portfolio and waiting for the right opportunity to show itself. And then you can always put that money back to work at some point. But this is just kind of the logical play. And what I want to really just, ensure is that when you're, especially if you're on Twitter, or X, right? That's like it's like the worst place to be. This is, just the issues that tend to happen. But like I said, I was just reading through some notifications on Saturday, and it was just it was quite amazing what people were saying. But it's just, you've got to be careful with all of this, and don't let these super negative outlooks impair your ability to manage your money, because that's where we make most of our mistakes. Nickelback is a terrible band. Nickelback has more hits than just about any other band on the planet. So I don't know, just our chat. You know our chat. Our chat is always in there. But so anyway, it does. Well, that wasn't on X. That was in our chat. Oh, in our chat. That was in our chat. Yes, that was. There's that. Yes. I was going to look through here and see if there was any questions or concerns about Iran, but apparently our chat is completely fine with this, so it's all good. So we're into that. So yes, tourism and travel is not going to do. If you're planning on traveling to Iran for a vacation, not sure why you would, but yeah, that's cheap rooms if there's any available, literally. There may be no rooms left, but yeah, we'll see. All right. If you have any questions, concerns, etc., get by the website, send us your emails. Always happy to help you out. We'll get into tomorrow the 10 laws of wealth and money with John Penn. And also, I'll bring you up to date on what happens with the markets today. Again, I would not, if you feel like you need to do something today, I would highly encourage you not to do anything today. Just go play golf today or go do something. Let's look at this tomorrow. Let's see how the markets kind of parse through all this data and information. And then we can make a better decision about how to risk manage our portfolios tomorrow. Just take today off. Yeah, I think you'll be better off at the end of the day, and we'll figure out how we are. So anyway, send us your questions, comments. Be sure to like and subscribe to the channel. We appreciate it very much. And we'll be back here tomorrow with John Penn, talk about the 10 laws of wealth and money. We'll see you then.